Today I wanted to talk about time frames as they apply to trading. Thing is, we keep talking, or I keep talking about day trading as if it's the only way, and of course it's not the only way. There are alternatives to day trading, other time frames in what we can trade. So wanted to look at what those are and why I choose to day trade as opposed to trading in other different time frames. So let's see what kind of time frames there are available. Now these are, for the purposes of this video, people might have different opinions on what constitutes these different kinds of time frames, but from my point of view, I would say that we fall into three main categories really. First of all, we've got day trading, as I talk about, and that to me essentially means having no position overnight. Whatever you buy or sell during the day, you close that position in the same day. So you have no position overnight outside of market hours. Then moving along the timeline there, come to swing trading. Now this one's a bit more difficult to define. People have their own ideas. For me, swing trading is anywhere between holding overnight just for one night, right up to holding a position maybe for up to a few weeks. So we'll say up to a month because that keeps it nice and simple. And then at the other end of the scale you've got buy and hold. This is your more kind of traditional investing, and I would suggest that's holding a position for anywhere from a month onwards. As I say, swing trading, buy and hold, bit difficult to say where the dividing line is, but I'm going to call it a month. Now each of these different time frames has got various different advantages and disadvantages, and I'm not trying to suggest that any one method is better than the others, or indeed that any of these methods are mutually exclusive. There's no reason why you can't day trade and also swing trade and maybe even have buy and hold positions open at the same time. And a lot of people will do all of those. It's one form of diversification, which is always a good thing anyway. And it comes down to personal preference, of course. Anyway, what follows really are my thoughts and the way I see the advantages and disadvantages of each of these methods. So let's go through them one by one. First up, buy and hold, and we're starting at the other end of the scale and working back down. Now, buy and hold, as I say, perfectly valid strategy, and this works for the likes of Warren Buffett, who is far richer than I would ever be, and usually up there in the top 3 or 4 richest people in the world. So if it works for him, then probably a good reason to do it. Advantages of buy and hold, as I say, holding for more than a month at a time. First off, you've got less screen time than day or swing trading, by which I mean you're spending less time sat in front of charts watching them move up and down. Your time is more spent really researching what you're going to be buying and selling. The actual buying and selling process is over quite quickly, and you're not watching every tick up or tick down in the price. You're not really concerned about what's going on day to day. You're more concerned about the longer term. And that of course means that we can profit from those longer term swings in price. On the downside, you essentially need to become a bit of an expert on the individual companies what you're trading in. If you're looking to hold over a longer period of time, usually you'll be basing your decisions on some kind of fundamental data, price earnings ratio, upcoming product announcements, all of that kind of thing. The kind of thing what you're going to be looking at, you know, if you think that such and such a company is undervalued compared to its peers, you need to understand how those peers are valued and how this company itself is valued and what's going to change that valuation. And as I say, it means essentially becoming a bit of an expert on the companies involved. So each individual investment what you're looking at buying to hold for a long period of time, you're going to need to do a fairly serious amount of homework on that investment. The homework that you do on that investment is of no use to you when you come to look at your next investment. Some of it might be of use to you. I mean, if you specialise in a particular sector, that may be of help to you. But by and large, homework and research done on one company is not going to be of use to you if you're then looking to invest in a different company. Another downside is you get to miss out on intraday price movement, and that's something we'll come and look at in a few slides time in more detail. Obviously, you need to be patient to see any profits arise out of buy and hold. This isn't for the impatient people out there. And your cash is going to be tied up in the market all the time you're in a position. So if you've taken out a long position on one company and put a lot of money into that, obviously that money is no longer available to speculate in other different companies or other different trading possibilities. That cash is tied up, you can't do anything else with it. Similarly, any profits can't be instantly reinvested. Profits are on paper for most of the time, they don't get realised into cash until you exit your position. So you could have bought a stock at $25, could now be worth $100. In theory, you've quadrupled your cash. Of course, until you actually take that, close that position, take that cash out of the market, you haven't really gained anything. And that $75 a share, what you've profited, you can't reinvest that into something else until you've closed out that position. So your money is tied up in the market, you can't be reinvesting it. You'll also be paying interest on any margin. Quick reminder, is when your broker lends you a certain percentage of the price that you're investing. So typically 4 to 1 when trading US stocks. If you pay $4 for a stock, you put down $1 and the broker lends you the rest, the other $3 for each share that you buy. When you're holding a position overnight, that money, what they've lent you, is effectively a loan, and therefore you'll be paying interest on that. So that's just something to take into account, is that there is an interest element there. And last but by no means least, you are exposed to major events, what may happen in the world and in the marketplace. And again, that's something I'm going to come back at look at in a minute. Alright, that's buy and hold. If we move back down the time scale, back down to swing trading, so holding anything from overnight to maybe up to a month. Again, less screen time involved than day trading, because we may look at position once or twice a day, to not necessarily every tick up and every tick down, but we can still profit from longer term movements in stock prices. And big advantage is we can base our trades entirely on technical analysis. So rather than looking at fundamentals, as I spoke about earlier, price, earnings, all that kind of thing, valuation of a company, we can do it that way. But for shorter term swing trading, can really just start looking at chart patterns and technical analysis and trade. It's just based off that, which is a big advantage, because we don't have this problem anymore of having to become an expert in a company what we want to trade. We can learn how to read a chart, learn how to read technicals, and that knowledge can then be applied to every stock what's out there that we could possibly want to trade. Now you can still do that in buy and hold type strategy, but really buy and hold, you really got to start looking at fundamentals on longer time frames. On the downside, you need to effectively do a bit of work every day that the market is open. You need to be checking your position and finding new trade opportunities, obviously, as well, and working out if you need to be exiting or not. So there's a bit more work involved, and you need to really check in on your positions every day as long as you've got a position open. You're still going to miss out on intraday price movement, and again, come back to this in a minute. You're still going to have to be fairly patient, and you're still going to be paying interest on any margin on your overnight positions. It's less of a problem because you'll have positions open for a shorter time, but anytime you do have a position overnight, you're paying interest on that margin. And you're still exposed to major events, what can happen in the market outside of hours. So it's kind of a middle ground, really, swing trading. Quite a few day traders I know like to start a trade as a day trade, and something may happen, chart may suggest to them that it's got further to go, and they'll decide to turn that into a swing trade, maybe hold it overnight onto the next day. That's kind of the minimum kind of swing trading, if you like. Bit of a middle ground, as I say. Okay, then day trading. Let's have a look at this complete opposite end of the spectrum now. Lots of advantages as I see it. First off, got no exposure to out of hours events, so close out our positions at the end of the day. China can come and declare war on us at 5 o'clock in the evening. It ain't going to affect our positions, not directly anyway. Might have other things to worry about, but our positions will not be affected because we haven't got any positions at that time. Our cash position is always there, available at the end of each day, so we can take our profits anytime we want effectively, and we've got that money available to reinvest in the market in new positions the next day. We're closing out, we're taking profit every day. We can profit from intraday price movement, which is a big advantage. Again, as with swing trading, we can and will really base our trades entirely on technical analysis, so no need to do deep research into companies. We don't really care what the company is when we're day trading. We're only interested in looking at a chart. Could be a chart for anything under the sun. As long as it's a chart that reflects a price, we learn how to read prices, and we can read that chart and trade it. And a big one for me is we can take days off without risk. You know, I'm flat at the end of each day, got no position. If I wake up the next day and decide that, you know, I want to get on a plane and go on vacation, or just don't feel like trading today, I don't have to look at a chart, don't have to look at anything. You know, you've got no position, you've got no risk, so you just trade whenever you feel like it. Not really an issue for some people, but for me, one of the big reasons why I took up trading was that kind of freedom that gives me. On the downside, trades do have to be managed in real time. So once we enter a position, unlike swing trading or buy and hold, where we might enter our position and then go off and do something else, we need to be sitting in front of the chart if we're day trading this, because at some point in the day we need to close out that position. So really we need to be in front of the chart so we can decide when the best time is to close that position out. Now, this is only a problem in as much as how much time you want to spend sat in front of a chart, really. As you know, I trade typically about 2 hours a day. That's okay, I can cope with that. I don't mind sitting in front of a chart for that kind of period of time. Okay, so let's go and have a look at the two biggest reasons I see for day